welcome back to Financial Minds Meet the Experts. I'm your host, Jaime Agostino. On this podcast, we're joined by financial industry experts to talk about topics, trends, and themes that credit union professionals need to know about. Today, I'm sitting down with Vizo Financial's SVP, Chief Treasury Officer, Tim Sustak, and SVP, Chief Investment Officer, Scott Wood. Let's get started. Tim, the Federal Open Market Committee held rates steady during the most recent meeting back in November, as well as the prior month of September. Are we looking at another hold from the Fed next week?
You know, Jamie, I think we are. I don't think the Fed's moving. I think most out there don't think the Fed's going to move at this point, at the December meeting, that is. And, I think most think that for a number of reasons. I mean, Chair Powell came out on Friday with a speech and made comments. He talked about rates being in restrictive territory, that he and his colleagues are expecting spending and growth to slow next year, that the risk of doing too much and doing too little as far as rates is, are more in balance now. So, certainly it seems like Chair Powell has not changed his thoughts or messaging much. Fed Governor Waller, who's a notorious hawk, came out in a recent talk and, talked about he was increasingly confident policy is well positioned to slow the economy and get inflation back to 2%. The economic numbers, haven't certainly pressed them at all. The latest PCE reading, the Personal Consumption Expenditures Index, that is the inflation number that the Fed follows, came out the most recent number of 3.5% for the core, ex-food and energy, and 3% for the headline number. So, that's certainly within expectations, not putting a lot of pressure on them. So I think they certainly do hold in December and keep watching and waiting. That doesn't necessarily mean that they're done. And Chair Powell and everybody else, all the other Fed speak that's out there, I think that's what we're trying to tell people is, look, just because we're not moving now doesn't mean that we're done. Chair Powell's a student of the 70s. He remembers what happens, when the Fed got soft in the 70s and inflation came roaring back. He's bound and determined not to make that same mistake here. So, I think there still could be more on the table. And I think we need to believe what they say. They're going to watch the data. They don't know what they're going to do yet. There's no preconceived pathway. They're going to look at the data and make adjustments accordingly. And for all those folks that, want to see cuts, I think, and Chair Powell has said it, look, it's just really premature to be talking about that. So, will that happen? It's certainly going to happen at some point. But at this point, I think we're still in for the higher for longer type mentality when it comes to rates.
All right. Thank you. So, Scott, I'm kind of thinking 2024 is just on the horizon. How many, if any, rate hikes are you predicting in 2024?
Well, first of all, I just want to start off saying I have my ugly Patriots sweater on today, Christmas sweater, as kind of commemorate the ugly season the Patriots are having. So the only team worse than the Patriots right now are the Carolina Panthers. So we're vying for that number one draft pick. So that's positive news with Carolina. So Carolina has one win, the Patriots have two, and it's really been an ugly season. So I just want to get that out there. I'm not a fair weather fan, grew up in Connecticut. I love my Patriots and will always love them. I've seen worse. Well, maybe I haven't seen really worse seasons, but they've had as bad as before. So as far as rate hikes next year, so I'm kind of along, I would agree with everything Tim said, and talking about what the different members of the Fed have said. There's been a lot of, up until the last meeting, there's a lot of mixed thoughts from the Fed on what they might do. There was a chance we might have another rate hike. We actually, in our official projections, which is my official projections for this year, I put in there one more rate hike. Whether I thought it would be either November or December. And this was, 3 months ago or so, 3.5 months ago. Obviously, things have changed. As Tim has pointed out, some of these issues, PCE, as he said, has come down, and the core PCE at 3.5% year over year a couple weeks ago. Positive news. A lot of positive things are happening, and the Fed has taken that mantra that they're going to, one, look at the incoming data. which, inflation is part of that. But there are also other economic indicators, obviously, that are important. Consumer spending is one of those. The unemployment rate is another one. The strength of the economy is kind of reflected in that. And GDP is another one. We had a really strong print in the third quarter. In fact, it was a rise higher this last week to, I think, 5.2% or somewhere like that for the quarter. So really strong third quarter. Now, that's in the rearview mirror. Are we going to see rate hikes next year is the original question. At this point, the likelihood is pretty slim. Based on the incoming data that we're seeing, inflation is cooling, as Tim pointed out, as the PCE numbers have shown, as CPI numbers have shown. Inflation seems to be coming down. So that doesn't mean that we have more purchasing power today, because we still had those increases in prices over the last 2 years. We're still at a high number, and people are still struggling. Some people are still struggling with those numbers, but the pace of inflation is slowing now. We haven't hit deflation, but the pace is slowing, and the Fed's view is that, hey, if we continue to give time for these rate hikes that we've already done to continue to filter through the system, that we may achieve a soft landing. So the Fed at the last meeting really they came out and said they thought that we would achieve a soft landing. The markets are on board for a soft landing or no landing, really, that the economy may just keep chugging along, and then the Fed may not have to raise rates more. So the odds of any rate hikes next year are almost 0%. It really depends, how these inflation numbers, if they continue to trend lower, likely the Fed's not going to raise rates again. In fact, when you look at the futures market, Fed fund futures, they're actually predicting that the Fed is going to cut rates next year, either starting in the late in the first quarter or early in the second quarter. So they have a meeting at the end of March, and then their next meeting after that is May 1st. The markets are given a 100% chance that they'll have a 25 basis point rate cut by the May 1st meeting. I don't think that's likely either. Tim alluded to this when he said, the Fed keeping rates higher for longer. They've talked about keeping the rates higher for longer. To me, if they hold that mantra, it would make sense to not cut rates early in the year. If they do a rate cut, more than likely later in the year, and really if the economy starts to weaken where they think they need to do something there, and it certainly could weaken. A lot of the indicators here recently have been trending more on the negative path. We're starting to see upticks in delinquencies, mostly impacting the subprime crowd, but certainly that has the ability to bleed into better credit. And it has bled into better credit to some extent. It's just not a worrying sign yet, but we are starting to see upticks there. So more than likely, no rate increases next year. Probably not going to get the rate cuts that the markets are looking for as quickly as they're looking for. If we do get rate cuts, probably later in the year.
Okay. All right. Well, Tim, do you agree with Scott's prediction?
I agree with absolutely nothing Scott said at all. No, I'm just kidding. I agree with everything Scott said. I think he said it very well. I'm in complete agreement. I mean, I think the Fed's trying to leave the door open in case they need to raise. But as Scott said, I think if things continue to march along as they have been, I don't think they need to. I think they've got it going the right way. I think they're, fairly happy with what they're seeing. So I think if things continue on, I think they're content to sit and watch and let inflation come down to their target. Likewise, I agree with Scott. I'd be surprised if, you never know, but I'd be surprised if we were in cutting mode, certainly starting in the first half of the year either, because I think they are going to make sure that they've got this taken care of, and that inflation isn't going to rear its ugly head again. So, I agree with everything that Scott said, and we'll see how it plays out.
All right. Scott, so the unemployment rate, it continues to stay around the 3.8% and has since, March of 2022. What impact does this have to credit unions and their staffing concerns and issues?
Yeah, so that's really been one of the big drivers of the strength in the economy is employment has held up very well. I think we mentioned this on one of the prior calls, maybe the last time or the time before, but when we were entering this hiking cycle by the Fed, they predicted that they would have to get the unemployment rate to 4.5% to 5% range, above 4% anyway, 4.3, 4.5, before they would be at that point where inflation would be contained, because if people are working and they're making money, they're going to spend money. That's just the way, the things work in the economy. So they thought they were going to have to bring that rate up higher. Obviously, we're still well below that 3.8 or 3.9%. So we still have what you would consider a tight labor market. We've seen the participation rate over the last little while has been increasing. So more people have been going back into the marketplace. Although there's still a gap of people out there that we lost during the pandemic from the employment numbers, and they haven't come back. 1 million or 2 million people that are still kind of missing out there, whether they're part of the gig economy or something else. There's a lot of debate, and there's probably a little bit of everything, right? Some people probably retired early. Some people are in the gig economy and they aren't working for a company, and just a combination of different things. Some people realized they didn't like the work that they were doing, so they're not going to do it again. So maybe they're in school to get a different type of education. And that's part of the issue with the employment. So we see these JOLTS numbers where there's millions of job openings every month, more than there are people looking for jobs still. Again, makes it more challenging for credit unions to fill these positions. And I can say at Vizo Financial, we're in that same boat. We've had these similar issues here where certain positions are difficult to fill, and a big part of it is a mismatch between the required skills for the job and the skills that are out there in the marketplace searching for that. And then another part of that is when you find that skill set that you need for the job, there's a desire on the employee's end, earn more money than they were earning, maybe 2 or 3 years ago. So there may be a bit of sticker shock for credit unions when they're looking to hire somebody new. I know a lot of places, we've seen a lot of the headlines where they've increased wages, minimum $15 or $20 an hour type of thing for new employees. So maybe you've already absorbed that, but maybe some of the issue might be with some of your higher paying jobs where the dollar numbers there have gone up quite a bit. So staffing is likely to continue to remain an issue going forward. I think if there's a positive piece of news here is in the banking sector, there have been some layoffs. So banks have been closing some branches. I've read an article recently about some of the large banks have closed branches. And if there's some that happen to be in your local area, obviously you may be able to find some good employees that maybe have lost jobs or might be losing jobs because of them cutting down their footprint for branches that they may not need. But it should continue to be a difficult year. Just based on the job openings and based on the unemployment rate, both very positive signs for the economy, not so positive if you're looking to hire new people.
Yeah, exactly. I was at a conference last week and there was a lot of talk about trying to find staff for the C-suite and the challenges of that. Because as to your point, higher wages and other things. So it's very challenging for these credit unions these days, as well as other companies. Everyone's kind of feeling the hiring blues these days. So Tim.
Yeah, the employees in the driver's seat right now, they have a little power that they haven't had for a number of years. And, I guess you can't blame them, right? If you can earn more money, you certainly want to try to earn as much as you can. So it just makes it challenging.
Yep, absolutely. All right. So Tim, let's talk liquidity. Are credit unions still feeling the impact of the tight liquidity position, or has that changed? If not, what should they be looking to do?
Yeah, I think they're still feeling it, to some extent. It is liquidity somewhat stabilizing. I think, for two reasons. Number one, it's that time of the year, right? Going into the winter months, fourth quarter, as well as, beginning of first quarter of the year, we see things start to stabilize somewhat for credit unions. And then we know by mid-end first quarter is when everybody's getting money in and they grow. So I think just naturally things are stabilizing a little bit for some credit unions. I think as well, credit unions have been working hard at liquidity, harder than they've had to for a long time. So, working at rebuilding cash stores and making sure they have, multiple sources of external liquidity, as well as, programs they're running internally. So they're using those. And I think, they've they've worked to help stabilize things. I think though you still have the haves and the have-nots, as we've talked about. You have some that are certainly feeling the strain much more than others. Those that extended out, really long in the investment portfolio rather than a more conservative laddered approach, or, those that either can't or don't want to pay up to keep deposits from leaving and going to, the myriad of other options that everybody has nowadays for money. So I think they're still have-nots, but I think overall it's stabilized some. What can they do? And I think it's the same thing that they've been doing, or the same thing that we've been preaching, right? It's not a bad time to have some money in cash. There certainly isn't that big penalty that we've seen in the recent past. Rates are pretty good, so it doesn't hurt to hold some of your dollars in cash and just rebuild that cash store. And building your toolkit for liquidity. Making sure you have the lines that you need and you've updated those. If you could become a member of the FHLB, you're doing that. Discount window, bank term funding, those who choose a CLF. So just making sure as you continue to go, you stay on top of those, fortify the toolkit if you need to, if you haven't done so already, and have as many tools as you can. And I think that's what credit unions would generally see them do. So I think, those credit unions that, we were seeing, 6 months ago in a panic because, money was leaving and loans are still going through the roof, and, they're trying to get things online to get external liquidity or get a CD special online. I think, like people got used to the really low interest rate environment. I think people have gotten used to this environment that we've been in now for, the better part of this year, where liquidity has been really tight and they've had to really pay attention. So, I think, keep doing what you're doing and paying attention to that. And, we'll all make it through together. So.
All right. Well, we're aware that some credit unions as well as corporates have been taking advantage of the bank term funding program. Will the Fed extend the program past the March 11th, 2024 date?
That is a good question, and one I wish I knew the answer to, but unfortunately we don't. And, last press conference, Chair Powell was asked flat out from one of the reporting staff there, will you extend? And he said, look, we just don't know. He just said, we're going to make that decision closer to the time that the program will end in the first quarter. So, I mean, we've certainly seen some usage, back when the program started. I think, March 15th, we were around $12 billion. Now we've been up and pretty steady, 115, 120. So, people continue to use it. I think it'll come down to a few things. I think, usage and what they think would happen if they pull that away. And also, I mean, we know why that was implemented, right? The fast run up in rate crushed bond asset values, and people couldn't stomach selling bonds to generate liquidity. So I think, we'll have to see where rates are at the time. I mean, rates ran up, certainly yields ran up in treasury. We've seen some of that back off over the last month, but I think, they'll be looking at that too and seeing, is the same type of penalty out there to generate liquidity from bonds. And if it is, maybe they'll extend. If not, they may get comfortable with letting it go, because remember, you can take a 1-year loan on the last day of the program. So conceivably, credit union can take a loan out and have a loan out through 25. So, there is some cushion there. It's not like when the program ends, you don't have that funding. You can still have that funding out a year. So they'll be looking at that longer game too.
Okay. All right. So Scott, what should credit unions be watching over the next few weeks, months as we enter 2024?
Yeah. So a big thing is this week's FOMC meeting. They meet this week, so there should be an announcement on Wednesday at 2 p.m. They'll come out with their statement, and then Chairman Powell will do a press conference afterwards. So obviously that's going to be vital to listen to that. What does it have? It's next week. I'm a week ahead. It's next Wednesday. I apologize, but yeah. So the Fed's in a silent period right now, so there won't be anything else until that Fed meeting comes. From the Fed, there won't be anything else. So next week's meeting, listen to what the Fed has to say. Listen to Chairman Powell afterwards. I think we've talked about this, and if not, I'll just mention it. The Fed has kind of been, in this tightening cycle, the Fed has been completely on point and transparent with the markets. And they've pretty much followed through with everything they've told the markets they're going to do. The markets were not always believers. Early on, the Fed was very aggressive. The Fed in raising rates, and the markets were way behind on what the Fed was doing, even though the Fed was telling the markets and everybody what they were going to do and how aggressive. The markets finally caught up, and then they dropped back off again. And then they finally caught up again until the last Fed meeting. The last Fed meeting, I would say there was a divergence between the markets, what they thought the Fed was saying and going to have to do versus what the Fed was saying and what they thought they were going to have to do. So we continue to rely more heavily on the Fed, but I feel like we've reached a point now in the cycle where the markets are going to start to take over. I have this feel like they've already kind of started to make them assert themselves. The bond markets have, and the Fed, I believe, is probably listening. The good news is the data kind of is cooperating, right? Where the Fed, the market's view is in line with where the interest rates are. Where inflation is, and where we're starting to see some weakness in the economy. So I think we're starting to get to that point where you're going to have to listen to a little bit to the markets too. So I think since the last Fed meeting, we've seen a big drop in yields. The 10-year we hit around 5% with the 10-year, and now we're almost 75 basis points below that. So the markets have really lowered rates quite a bit. Rates have dropped a lot. I think it's a little bit overdone, but more than likely we've hit the peak in yields. Unless something, we see a spike in inflation or something, we probably are not going to go back to the 5% 10-year anytime soon. I'll listen to the Fed, but also, I think the markets have overdone it a little bit. So we should see a little bit of a pickup in yields. I'm anticipating. We see a little bit today in the markets, or we're up a little bit. In addition to the Fed, continue to pay attention to the PCE deflator, which is a monthly reading that comes out towards the end of each month. They normally look at the core. They like to look at the core reading, which was 3.5% year over year. Continue to look at the CPI reading. It's another key inflation reading, which has been tracking lower. If those continue to track lower, then there's less likelihood the Fed is going to have to raise. Where the Fed might get into rate cuts is when we start to see weakness in the economy. If you start to see the unemployment number tick up, if we start to see more jobless claims, if we start to see the JOLTS numbers come down where there's less job openings, those type of things are kind of indicators. Fourth quarter GDP will be big too to let us know if consumers are still spending. We did hear positive news coming out of Black Friday that consumers were still spending. I think part of the issue though is a lot of the spending seems to be done on credit. The credit cards are starting to max out and build up. So pay attention to these type of things. Pay attention to default rates, late payments on credit cards, and auto loans. You have a lot of this stuff credit unions do internally that they can look at. So you don't have to wait for the national data or quarterly data to come out from the NCUA. You're going to see these trends in your credit union more than likely. At the very least, you're doing consumer loans, auto loans. Maybe if you're not even in the credit card space, at least you're seeing some of this. So pay attention to these type of things. Used car prices have been coming down. So here in the last month or so, we're starting to see a little bit of a downtick there. So does that impact your members paying on their auto loans, that maybe they borrowed more than the car is worth today because at the time the market, it had built up so much. So there's a lot of potential warning signs to keep an eye on, but really listening to the Fed, Chairman Powell, obviously is the leader. He is the voice of the Fed, but pay attention to the other members too. Some of the more hawkish members who maybe are kind of becoming more dovish in their statements. Maybe we don't need to raise anymore. Maybe our next move is down, but we're going to stay higher for longer. We're still going to keep rates up there. So just pay attention to what they have to say.
All right. Thank you. Any final thoughts for our listeners today? Tim?
I would just say, kind of what we've been preaching. I think, if you haven't been working on it because you thought you haven't needed it, or most of the credit unions out there have needed it. Keep working on those liquidity resources. Even if you don't need it now, most of these programs you can get up and running with, some fairly simple paperwork. It doesn't cost anything to have them, and the time to get stuff like that up and running is when you really don't need it. Liquidity cycles come and go. This one will end, and at some point I won't need it, and then we'll need it again. So it's always great to have that stuff in your hip pocket when you need it. That way you're not struggling when something happens. And it doesn't have to be just one of these normal liquidity cycles. I mean, liquidity problems can happen, at institutions individually for a lot of different reasons. So never hurts to have liquidity options in your toolkit. So keep working on those.
All right. Thank you. Scott, any final thoughts?
No, I mean, I would definitely agree with Tim. Get those liquidity things in place. And we have seen a lot of that. We've had a lot of credit unions signing up to be issuers of jumbo CDs through the Simply CD program. It's relatively quick and easy to get set up. No cost, obviously, if you never use it. The bank term funding program, we can, internally, we can help you guys get the paperwork set up for that, walk you through the process if you kind of have questions and things. So there's the different resources. The one that I will throw out there, too, that we haven't had a lot of requests for recently, but we did initially, right? When the Fed started raising rates, probably, a few months in, we started getting a lot of requests on the investment side to price up securities to sell early. And the losses were pretty ugly. And the losses are uglier today than they were in a lot of cases. But in some cases, you're getting closer to maturity, so the losses may not be as great anymore. They might be more manageable. So I would say as you get into the new year, it may make sense to reach out to your investment rep at corporate or what other institution you work with, and just see what it would look like to do maybe a bond swap, because yields are still attractive. So it may be that you can swap out of some underperforming bond and into something new with a higher yield. Then your break even might be 6 months or shorter, or maybe a little bit longer. But if you do it earlier in the year, give yourself 11 or 12 months to make up the loss if you needed it. It may be a strategy that makes sense where you can lock in some attractive yields for longer term. This would be the time, if you have the cash, to do that. So even if you don't want to do the swap, but you have some excess liquidity, you think that it's not going to go away next year, and that's a big unknown. As Tim pointed out, we don't know what next year might look like. Beginning, it may get worse, but if you have some excess cash that you think might stay around for a while, look at doing some longer investments, in that 3-year range. Usually credit unions don't go beyond 5 years, but we're past the peak. But I would say, we may, as I mentioned earlier, we may see a little bit of an uptick in yields here because this little part has probably been overdone a little bit. So look to deploy some of that cash and some things. Just lock in some yields if you can, if you're in that position to do that. And again, we're happy to help out any way we can with that.
All right. Well, thank you both so much for joining me today. I appreciate your insights, as well as I know the audience appreciates it as well. So as always, thanks so much for listening, and make it a great day.